Me aloitellaan. Welcome to follow Cramo plc's third quarter 2013 interim report presentation. I am Vesa Koivula, and as usual I have here from our management our CFO Martti Ala-Härkönen to tell you about the figures of Q3. We have a kind of standard agenda here. At the end of the presentation, I would like to give some ideas of rental business growth drivers and how we see that the value creation potential is within the rental industry. So that is something new which we will present this time. So welcome to follow our presentation. During the summer and autumn, economic uncertainty in Europe has turned into a steadier development, meaning that uncertainty has decreased to a certain extent in our countries of operation. The economies in the Eurozone are estimated to take an upward turn somewhere during next year. There are still considerable differences among European markets related to construction activity and demand for rental services. This means in practice that construction is declining this year in many markets like Finland, Sweden, Poland as an examples. But also growing in some markets like Norway, Germany and Russia. Forecast towards next year, 2014, indicate a certain growth in most of our markets, and I would say in all our markets where we are operating. Demand for equipment rental services started to develop satisfactory in many of our market areas during the third quarter. We have continued our strategy of rolling out a uniform business model, which we combine with operational efficiency improvement. And these measures, combined with cost savings made already earlier and some of them still ongoing, those helped us to improve our profitability now also in the third quarter. We achieved a good result in Finland, Sweden, and Eastern European segments. Within Eastern Europe, profitability was good in Baltic countries and Poland, and on a satisfactory level in Czech and Slovakia. As expected, Russian joint venture Fortrent improved also its profitability in this quarter. Norway and Central Europe achieved a satisfactory and Denmark a positive result. For now on, already now I want to highlight that we will keep our cost level low for further profitability improvement as the markets start really improving and the sales starts increasing, especially towards next year and during next year. Our development so far during this year shows that in this sense we are on the right track at the moment. Then if we take some highlights of before going more into details of the figures, so in Q3, even though the reported sales was down minus 4.8%, but if we compare comparable business units and in local currencies, actually our sales was a little bit increasing. So plus 2.5% was the comparable sales. EBITDA margin in quarter was 18.6 on a reasonable level. EPS 48 cents, and especially we are satisfied with our cash flow. Cash flow was plus 26.4 million euros, clearly stronger than last year. In 9 months, sales down if we exclude the divested operation and restructuring in Russia, minus 2% sales. EBITDA margin 11.4, last year 11.1. But again, if we take into consideration non-recurring items, our margin was 11.6. Earnings per share in 9 months, 63 cents. Cash flow, also here a highlight, 15.9 million, especially when we consider that this includes earlier made acquisitions worth of 26.2 million euros. Gearing, I would say, steadily now developing to more positive. Gearing is 82.9. Martti will maybe comment more in details on this, but we expect, and we do at the moment, the performance so that we expect that this will further go down when we go towards towards the end of the year. Next, I would like to summarize some of the most recent estimates or indicators where the economies are. First of all, here is the very fresh European Commission lead indicator for overall economic sentiment, which shows that the latest development has been improving, or the sentiment has been improving in our markets, Sweden, Germany, Denmark and Poland. As we feel here in the Finnish economy, for Finland this has not yet been showing improvement. Will be seen now when the especially the labor agreements, etc., just lately made here, when this could then start also improving the sentiment in Finland. Further, construction confidence lead indicator, also from EU. Green line here indicates pretty stable sentiment in Germany, and for Sweden and Poland the most recent development has been positive. So far Finland and Denmark has not yet shown improvement here. Further, if we summarize the GDP expectations in European markets, and especially in those markets where we operate, as we know, this year will be somewhat negative for Finland and very small growth in most of the markets. But for next year, it seems that in those countries where we operate, there is good turn to more positive, showing above 2% GDP growth for Sweden, Norway, Poland and Russia, and on other markets where we operate somewhat lower. I think what is good to note also is that in those areas where we are not operating and will not operate, meaning the southern European countries, also there seem to be now start at last somewhat positive development, which definitely will give more confidence also on our markets. Then summarizing the backlog of orders of our biggest Nordic clients and comparing that with the historical development of our Nordic sales development year on year. Few comments here. Second quarter was up by around 4%, 3.7% from the previous quarter, so positive trend there. But still, it was slightly down on year comparing last year second quarter. Another historical comment here is that it seems that our Nordic sales has correlated with this order backlog with a lag of 3 to 4 quarters. Of course, now it's to estimate that how the further development will be, but one could read from here that the order backlog seems to be bottoming now, and most probably then, especially next year, will start improving. Okay, and then here I show a case Finland just to illustrate that how our sales rental market has been behaving compared to construction market. Especially the right-hand side graph shows from 2009 to 11, rental market growth was surpassing the construction growth, as is seen here. Then the next phase from 11 to until today, construction market has been declining so far, but our market, meaning rental market, not declining. I would say pretty stable, even some years of small growth. And now we have shown here the next year expectation, which is from VTT, from European Rental Association, estimates that the rental market most probably start small growth in Finland. So this is just to show how normally our rental market is behaving compared to the construction market. Then if we continue, follow up our last comments regarding the confidence among European rental companies, I commented in Q2 that when the current business condition was improving clearly from previous quarters, so the expectation was that also the quarterly activity will start improving, and this is now seen here. So both current business conditions and quarterly confidence is now or has improved, very much driven by UK, Germany, and Nordic region as well. Okay, then I leave the floor for Martti for further comments.
Thank you, Vesa. To start with, in a still relatively weak market environment, we are pleased to report continued improving profitability and a strong cash flow for the group in the third quarter of 2013. But let's start looking more closely on the figures, starting with sales. In the third quarter of 2013, our sales reached 173.6 million euros. That's a decrease of 4.8% against last year. However, and as Vesa already said, for comparable business units in local currencies, sales were yet up by 2.5%, so there was sales growth. I will in a moment outline that a bit more in a moment. Segment-wise, our sales increased in the third quarter in Norway and Central Europe, whereas declined in other business segments. Generally speaking, fleet utilization rates were at a good level in most of our countries in the third quarter. And accumulated for the January-September period, the group's sales reached 482.2 million euros. There is a decrease of 4.3% year-on-year. However, when we take into account that we exclude the divested operations or sales from those divested operations and the restructuring in Russia, that is that we transferred our Russian business to a joint venture starting March of this year, the sales growth accumulated was 2% decrease. So what is really worth considering and looking at next is the sales growth breakdown for the third quarter. And to start with, we start showing here the reported sales growth for the third quarter, which was 4.8%. But however, the foreign exchange had a negative impact on our sales in the third quarter. That is mainly coming from the Swedish krona and Norwegian krona, which were weaker in euro terms than in the third quarter of last year. So when we count the sales growth in local currencies, the decline was 2.7% minus. Then in the third quarter of 2012, we had an exceptionally large one-time deliveries to the Copenhagen Metro project in Denmark, which totaled 4.7 million euros. If you look for any past quarter in Denmark, that was one of very large scale delivery. When we exclude the effect of that, so for comparable ongoing business, the sales growth in local currencies was a negative only by minus 0.2%. And then when we put on top of that the restructuring effect from Russia, that is that we transferred our Russian operations to the joint venture, there was actually a growth of 2.5% in the third quarter. So I think it's really worth considering this. So sales were not at all as weak in the third quarter as one might first think by looking at the euro-based figure. And of course, even more important is that where do we go from here? That how does it look going forward? Vesa already highlighted the leading indicators, and he will later present very fresh data from the European Rental Association from October this year. I can already state here that there's much more optimism in the air now going forward and looking into 2014, and it's a fact that looking at the base case and all the market estimates, they predict market growth for rental for 2014. Looking next at our EBITDA in the third quarter, our EBITDA reached 32.3 million versus 31.2 last year. That represents a margin of 18.6% versus 17.1 last year. So the margin was up by 1.5 percentage points. There were no non-recurring items in the third quarter. We had some, again, one-off cost in Germany about 0.3 million, but that's not been recorded as a one-off charge. Segment-wise, Vesa already shortly commented, I will repeat here, profitability improved specifically in Sweden, where we already see some signs of an improving market, and Eastern Europe. Eastern Europe, we are very satisfied with the lower cost structures, and we also see their markets moving towards the better. Good level of profitability was reached in Finland, Sweden, and Norway. Satisfactory profitability in Norway and Central Europe, and a positive result in Denmark. In Denmark, however, if we exclude the effect or the result effect of those large-scale deliveries to the Copenhagen Metro project, there also the underlying profitability improved year on year. And basically two main reasons can be highlighted as the sources of an improved profitability. First of all, it's the effect of the cost savings and other efficiency measures carried out, and second is the implementation of our strategy, which is starting to bear fruit. And there, in particular, I want to highlight the rollout of a uniform business model. That's a Cramo rental concept across our countries. It's the implementation of efficient processes and also a harmonized performance management system, along with the other must-win battles. That is the strategy implementation of the group. In this picture, we can also see that there's an improvement trend in the profitability since 2009. And still to stay the accumulated January-September EBITDA, in comparable EBITDA before the effect of the non-recurring items, we had some non-recurring items in the first quarter this year and last year in the first quarter. The EBITDA was 55.7 million euros, representing a margin of 11.6 versus 10.7 last year. So there's also an improving accumulated EBITDA margin with 0.9 percentage points. What's been very instrumental is, of course, that the group's fixed cost savings have continued in the third quarter of 2013. Here we can see a fixed cost comparison as measured through employee benefit expenses, other operating expenses, and depreciation, both for the third quarter and accumulated January-September 2013. And as we can see, the group's fixed cost savings, the fixed costs have decreased by 18.4 million, or 1.3 percentage points compared to sales in the period of January-September 13 versus last year. And what's really positive here, as I see, is that very clearly the fixed cost savings have continued in the third quarter in all those categories. In the third quarter, the fixed cost savings totaled 6.6 million euros, or 1.2 percentage points in relation to sales. And as Vesa already stated, our aim is to keep the cost base low also going forward. So it's now to wait for the sales growth to come at a certain period then in the future. The earnings per share for the third quarter reached 48 cents. There is growth of 10% year on year from 44 cents a year earlier. And at this stage, it may be worth commenting also on a few other cost lines below EBITDA that have had an impact on the earnings per share. In particular, there is a major improvement in the group's net finance costs. For January-September 13, the finance cost totaled 11.11 million euros versus 15 million last year. There is an improvement or saving of 3.9 million euros, or about 26%. And this comes from many sources, in particular lower interest rates and also lower margins affecting the finance cost net. For January-September, the group's effective tax rate was 21.9% versus 23.8% a year earlier, so there's also an improvement. And at this stage, 21.9 is perhaps the best estimate also for the full year of 13. And for January-September, what's important also to note is the comparable earnings per share, excluding the effect of the non-recurring items. That was 68 cents versus 54 cents a year earlier, so there's an improvement of 26%. The return on equity at the end of third quarter was at 8% level. We are still below the group's financial target of 12% or over 12%, but I can state that all efforts continue to reach the target level. In the third quarter of 13, the group's gross capital expenditure totaled 31.9 million euros versus 33.5 a year earlier. There's a reduction of about 5%. And following what we said in the second quarter in this presentation meeting, however, the level of capital expenditure was increased from the earlier 2 quarters of 2013. This was a result of 3 reasons mainly. First of all, there's an improved outlook, particularly in the Swedish market. Second, the further continuation of rolling out our Cramo rental concept in Germany. That means, of course, a gradual enlarging of the product portfolio there. And finally, there has been continued good demand for modular space in the Nordic countries. And for the 3 quarters, January-September, the total capital expenditure, including also the acquisitive capex, which was 31.2 million in the first quarter, was 98.9 million euros. That is also 0.6 million less than a year earlier. So including the acquisitions, we are below in the total capex, and of course with organic capex we are clearly lower than 2012. At the end of the third quarter, group's investment commitments totaled 24.9 million euros, the majority of which was again related to the acquisition of modular space. Then another highlight of the third quarter was really the strong cash flow. In the third quarter, the cash flow after investments totaled 26.4 million versus 6.4 million last year. So there's an improvement of 20 million euros in 1 quarter. So the cash flow after investments was more than 4 times as high as last year, or over 300% better. And in the third quarter, we can also see that the operational cash flow was at a, one could say, record high level at 50.9 million euros. I would want to highlight here that we have also succeeding in continuing to further reduce the net working capital of the group. For instance, at the end of the third quarter, the rolling 12-month net working capital as percentage of sales was at 4.4%. And what the picture also shows here, that in the first quarter we had those acquisition-based cash flows, which took in that quarter the cash flow after investments negative. the cash flow effect of the acquisition was 26.2 million euros. But what we can also see here is that the whole picture shows 19 quarters since 2009. And out of those 19 quarters, in 15 quarters, we have had a positive cash flow after investments. And actually, if you take out, there is the first quarter of 2009 after the Lehman crisis, there was a small minus. But after that, all those other 3 quarters where we've been on the negative, it has been clearly because of the larger acquisitions completed in those quarters. All the rest we have been positive cash flow, which I think is a good sign for the group of its cash generating capacity. Finally, looking at the group's capital structure, the group's gearing at the end of the third quarter was 82.9%. There's a clear improvement in the gearing versus last quarter's 92.4%. That's minus 9.5 percentage points. And I think that's a very good achievement with strong organic cash flow in just one quarter. Earlier in the second quarter, there was the gearing increased, but that was mainly as a result of the repayment of the group's hybrid bond in the end of April. And overall, the gearing stands and is meeting the group's financial target level of maximum 100%. And all in all, I think I can state that the group's capital structure and financial position, they are strong to enabling the further development of the group's business. Before handing it back to Vesa, I want to close that. At this stage, I think it's interesting to look really towards 2014, which from a market perspective, in general, it should hopefully also be a better year for our rental business. And finally, at this stage, I want to state that all the group's major initiatives and programs, they are targeted at a further improvement in the group's profitability.
All right, thank you. As usually, let's then continue with some more comments per business segment. Starting again from Finland, sales was decreasing, affected by weakish market situation, but of course also because of the divestments made earlier last year. So sales in the quarter was down minus 3%. Demand especially for modular space, standardized modular space projects continued, and we expect to continue on a strong level also in the coming quarters. Then profit-wise, our EBITDA margin, we could keep in 9 months our profit margin on the same level than last year, which we are. We think it's an acceptable level in these circumstances. And in the quarter, we made 25.6% margin. Situation in construction, as we know, is still pretty weak in Finland. But taking that into consideration, and how I highlighted already earlier, taking all these conditions into consideration, so rental industry is still doing, let's say, acceptable level of business, and as we see, we are doing decent profits also. Some estimates of the outlook. Euroconstruct estimates some decline, 1.2%, whereas the local estimate is more bigger minus for this year, and actually a slight minus also for next year. So this is the present outlook. On the other hand, for rental industry, it looks that next year is positive growth for overall rental industry. Sweden, a little bit similar situation, but we made a strong quarter. Anyway, sales decreased by 3.9%, which is in local currencies 1.2%. So after, I could say, more difficult first half a year, the situation has been now, especially lately, we see that it's starting to improve in Swedish market. Especially it's showing signs of picking up. Stockholm area has been strong also all the time for us, supported by some of the very big projects. Northern Sweden continue to be good area for us, and also we see that western part of country is towards next year and during next year also picking up. So this means that our fleet utilizations are on a good level in Sweden at the moment. Profitability, as I mentioned, in quarter was on a good level, even higher than last year, 23.8% margin compared to 21 last year. And as in Finland, the 9 months profitability was basically on the same margin than last year. For the future, the estimates have been now a little bit improving for the Swedish construction market, and also the same for the rental market. So there is now, I would say, clear expectation that the construction will grow next year. Late development from our experiences could show that this is a realistic expectation also, and that is how we are also now planning our operations further. For Norway, Q3 sales increased 11.3%, somewhat more in local currencies, meaning 19.5%. As we have seen in previous quarters, the construction and their rental market demand is on a good level, especially in the civil engineering sector, in some energy industry sectors, and on the west coast, where actually we are not strong enough. And of course now we are taking measures to strengthen our operations, especially in those areas. Our EBITDA profit improved in the quarter from last year, but the margin was on the same level, 9.2%. 9 months we made a slight improvement in the profit margin. So this means that we are continuing to seek more strength for the operation, and this means to seek for further growth and improved profitability. It's clear that with this level of profit, it's not acceptable for us, and we are really putting more and more resources to improve this situation. Especially when continuously the outlook for Norwegian market seemed to hold on a very positive. Local construction estimate is +3%, and even higher growth is expected from Euroconstruct. And this reflects, of course, to the rental industry expectation, which is also a good plus for next year. So our work continues here. Denmark, sales decreased, reported figure decreased 45.6%, but here we have to make a note that we have made this Copenhagen Metro, let's say, special sales project or part of the project, and taking this 4.7 million euros value into consideration, so comparable sales decrease was 15.7%. And of course this comes very much from the fact that now we are smaller operation when we decreased earlier the number of our depots with the closing 11 depots. We see that some slight picking up has been now realized, especially in the Copenhagen and Aarhus areas. And we have a good market position, and we have very strong order backlog and quotation base for our modular space activity in Denmark, which is another good leg with which we will strengthen further. Talking about then the profit, of course, it's clear, as we have commented earlier, we are now on the way to produce a plus result, which is definitely our aim, and then taking next steps to have during next year more acceptable level of profit. So this year we aim to have anyway the plus result and not anymore making a loss. Overall, market is starting to develop more favorably, which means that there is now plus growth expectation for construction for next year. And again, for rental, this means also that the market is expected to grow. For Central Europe, sales increased by 17.7%, so a good level of increase in sales, which means that the market started to improve already during the second quarter, and this has continued in the third quarter. Margin wise, we are somewhat below our I would say our target levels. This is mainly caused by those measures which we have commented earlier, that we are making a big turnaround in our operation there, which is ongoing in the plan, and this causes some extra cost, but also some extra work, and this is slightly seen also in our profit margin. But this work is now continuing, and actually just lately we have put more resources also on this to safeguard that we are really continuing on the right track, which we at the moment are. As we saw from previous comments about the German indications, lead indicators, German market seemed to be pretty stable, meaning stable construction growth and reflecting then to rental market also having a stable growth, which we believe will continue in the coming years. Eastern Europe, as Martti commented, we are satisfied now with performance here. It has not been easy area. There has been very difficult market situations in Poland and Czech, but as we have already said, we are now making a pretty good improvements in those areas. This means that in figures our sales decreased 23.3%. Of course, this is very much related and caused by shifting our operations in Russia to this joint venture for Trent. EBITDA improved clearly from last year. Margin in third quarter was 28.8, comparing 18.5 last year. As we commented, we have made a good result in Baltic countries and Poland, and also Czech and Slovakia are now in this very difficult market situation now improving. For Trent, couple of comments. Sales was 13.4. It's somewhat down from last year. That reflects that the Russian construction market seemed to be growing, but it's the market is somewhat weaker than was expected earlier. On the other hand, our EBITDA is on a positive improvement trend. So EBITDA was 2.1 million, 15.7% of the sales. And this means that we recorded in third quarter 500,000 booking from joint venture in Russia, reflecting this profit for the period 1 million. So that is continuing as we actually guided after second quarter that during the rest of the year we expect that the profit will start improving. There are different outlook figures for different markets. Euroconstruct and VTT forecast for 3% growth in Baltic area for this year. Some 3% growth in Russia. And as we see here, Poland still -6% and Czech and Slovakia also -6%. But for next year, also in those areas, expectation is somewhat more positive, definitely. Okay, then I promised in the beginning that at the end of the presentation we could have some new things to comment here. First of all, just to repeat that how we see that what are the growth drivers for rental business overall going forward. Increasing rental penetration, yes, depending of course on the markets. Rental related services are increasing depending on the market. Exchange of manpower for machinery, environmental issues and energy efficiency and sustainability issues. Renovation of construction, that gives good boost also normally for the rental industry. And demographic changes in different countries, not least in the Nordic countries, which will cause more construction, but also increases like our modular space business especially. But here I would more like highlight these rental penetration or rental growth expectations. This is a summary of 2 years estimates, 14 and 15, made just recently, trying to illustrate that what is the potential of rental industry in different countries. So if we take our countries, the best expectation actually is in the coming 2 years in Poland, followed by Finland and Germany and Norway, and then Sweden and Denmark as well. Also, we see that the highest expectation is in United Kingdom, 4.5%, same level than in Poland. So this is something which, if this happens, gives definitely a good potential for our industry to grow further. Then, how to describe that? What is the operating leverage in our kind of company or in our kind of industry? This is the illustration, but describes in principle, in a simple way, what is the leverage. We take an example here. There is a company having sales 100 units, gross margin 65%, EBITDA margin 12%. What is then the degree of operating leverage? Gross margin divided by EBITDA margin. This gives, in principle, 5.4 multiple for degree of operating leverage. Let's suppose that the company is growing 5%, So this gives a theoretical EBITDA increase of 27%. Of course, there are few assumptions built in, and that is that the increase in sales generated with no increase in the fleet, so with the existing fleet size, and with the existing cost base, so no increase in cost. But on the other hand, this does not consider price increases. So then it becomes, of course, more complicated. But with this, I just want to highlight that there is a certain operating leverage if the company can really control well enough the cost base. And of course, on top of this then comes in practice price increases, etc. So hopefully this gives some idea how we see that the leverage potential going forward is really there. Okay, then just to give you a kind of teaser slide here, we are developing our brand promise further. You will see this more hopefully in the future. We will disclose something more out of this. Now you see already that our new slogan is "For a great day at work." So this includes that we want to help our clients to have a good day at work. So a kind of day when the things simply go the way they should. They go the right way. So we are really now putting efforts to build up our customer promise, and why not? This is related with our branding as well. So you will see more out of this in the future. Okay, it's good to stop maybe here in this positive statement, but maybe summarizing our messages here. So we see that the demand for equipment rental services developed satisfactory in many of the markets. The economies in Eurozone are estimated to take upturn somewhere during next year. Still there are these big differences from country to another, and the latest estimates of our equipment rental market are now more positive. And as we earlier confirmed, our new a little bit changed guidance, so the guidance is then here seen on our slide. Okay, with these comments, we feel good to continue this fourth quarter ongoing, and thank you for your attention. And now it's time for questions from this audience here. Please. Who would start? Tony.
Tommy Lemoni from Carnegie. I have two questions. First of all, can you talk about price increases or decreases that have taken place in the third quarter in different markets? And the second question is regarding your fleet utilization. How much extra volumes or sales can you generate with your current fleet, excluding price changes? Thank you.
Okay, if I start with this price question, if we see all the markets together, no dramatic changes seen at the moment, so pretty stable situation. Some differences in Finland, especially in the capital area, no let's say big issues. Somewhat tougher situation in the smaller cities. For Sweden, overall pretty stable situation. No issues at the moment with the pricing. Which is seen also that our utilization is on a I would say on a very good level in Sweden at the moment. Where we see that the prices are too low, it's especially Norway and Denmark. In other areas, of course, when the market has been, like in Poland and Czech, market has been really suffering. So there has not been really good room for improvement. But at least we have made price increases here and there. So that means that the prices have not gone down anyway. So I don't see at the moment any big issues around pricing. Then I think I could refer to this leverage potential slide when you asked about how do we see the potential with the existing fleet to improve. I think it's there described.
Maybe I could add that maybe in a few countries, for example, Norway, we made some outsourcing cases early on the year. We have still fleet and a potential to improve utilization rates. Also in some product groups in other countries, for instance in Sweden, in tools, for example, we feel we can still improve. On the other hand, with the growth prospects in Sweden, we also need to start investing in certain areas also for growth in Sweden based on our anticipation. And of course, pricing picture looking into next year should hopefully give potential for at least gradual price increases taking place.
But it's fair to expect that you will start increase your capex next year.
That's yeah. Of course, now you see that our capex is on a pretty low level. So some increase is most probably. But the good thing is that we don't have to decide yet. So we can just continue with this, and you can be sure that it will be. We will keep very tight on further investments. But with this outlook, I could expect that when we are end of next year, our capex would be somewhat higher than this year. All right. Some more questions.
The markets. I've got my questions here also. On Finland, first of all, can you say actually what kind of market share you have outside of construction? Because you comment that basically everything's fairly okay in other industries. Is there any way to describe that?
That is a very difficult question. We would like to do some kind of, and that's the work which we have to do. At the moment, I don't have such kind of reports that I could really comment on that. Why we comment there is that we have, as we have disclosed also here, and it's built in our strategy, that we do efforts and strengthen our sales towards other industries. And that we see that we have increased our sales and profit towards other industries. That's a good point how to then describe or estimate what is really our market share. But honestly, at the moment, I don't have any means to estimate it yet.
Okay, and then basically on East Europe, is there a way to kind of split the impact of Fortrend in the result and then the cost savings that are also ongoing in the division?
Yes, I mean, you can take from the EBITDA out 0.5 million, which was the Fortrend contribution. And when you take 0.5 million euros off from the EBITDA, you can still see that compared to last third quarter, the improvement in profit, there was clear improvement in profitability. But Fortrend's contribution was that 0.5 million.
And that was also, there was some cost savings still impacting that one.
Sure. I mean, the cost savings have been really instrumental, for example, in Poland as an example. There is, in the bulletin, there is the European Rental Association's estimate for rental market growth this year in Poland, and the figure is minus 17.2%. And the construction growth estimate is minus 6%. So you can understand the market has been extremely difficult, but at the same token we have been extremely satisfied with the cost structure layout that we have done and the efforts, and we are commented that we made a good profitability in Poland in the third quarter. So of course it tells that we have succeeded in the cost adjustments there. Next year, Poland is estimated to grow both construction and rental growth.
Okay, and then kind of an old question, but on EBITDA and amortizations, I suppose that is probably nearly 100% related to Sweden, am I correct? Or are there any other amortizations in other divisions? Just trying to find out what your EBIT margin is for the reported divisions.
Okay, I mean the amortizations, they relate to the acquisition completed, and they come from different countries.
But just I mean, is there a way to describe just in general how big a percentage is related to Sweden and maybe let's say Norway? Is that roughly 70% of the amortizations are reported under Sweden, or?
I don't think we have a breakdown for that, but a big part of that relates to the Cramo acquisition back in 2006, and intangible assets related to acquisitions, they were divided to the cash generating units, and of course with Sweden generating already then quite an important part. So relatively large part of that is reflects to Sweden, but it's not only Sweden, it's all the other countries as well.
Okay.
And the normal level for that is about 3 million euros per quarter.
And then the final one is just on depreciations. Is the current level sort of a run rate right now? I suppose, okay, if you will see, let's say, roughly a small portion higher capex next year, then I suppose we should expect depreciations then going up year after that one, or how would you describe?
It will depend on next year's. At the moment it's correct, because we have basically in the equipment rental side slightly been downsizing the fleet, been really tight, so the growth capex has gone to modular space. And I already mentioned when I talked about the capex in the third quarter, the 3 areas where we were some improvement outlook in Sweden, and then I mentioned Germany, where we're continuing the rollout of the concept of modular space, and I think those 3 areas could be expected to gain a share of growth capex also next year.
Okay, thank you.
All right, thanks. Further.
Artem Beleski, SEB. A question regarding your thoughts about 2014 and optimism, what you're having there. Could you talk maybe more about reasons behind it? Is it European Rental Association estimates and GDP numbers where from your thinking is coming, or what is in general atmosphere around the construction companies and so on right now?
Yeah, of course. Why we elaborate here is that the fact is that we are so much related with construction industry. And first to show the figures, that's what we are analyzing from as many sources as possible. And with this, it seemed that there is now a certain more positive trend starting. So that is our assessment. When clearly the outlook figures are more positive than before and than this year. Then there are certain areas, of course, where we or all areas that we get feedback from our clients and from our management, of course. And there are differences. Finland is still, I would say, pretty negative. Sweden somewhat more positive. This is also the feedback which we are getting from the market. This does not mean that this is some. We have to be, of course, cautious on this, but we want to show that we feel that this is a good sign of improvement. So as we write also there in the report, so we see that next year will show more positive market. But as we see from the figures, it will be not any huge growth anywhere. And of course, cautiousness have to be there because these are just now outlook estimates. But we see more positive towards next year.
Okay, thank you.
All right. Anyone else? More questions? Do we have anything from web?
The questions from Ari Järvinen at Danske Bank Markets. First one, excluding acquisitions, outsourcing deals, what was change of sales in Norway in Q3?
I could comment on that. We haven't disclosed that because that's for a single customer, and that was also an outsourcing deal where we made a very long contract with a partner, and that could be considered and is considered kind of organic growth. However, that much I can tell that if we would exclude that, we would still be slightly positive in the third quarter. So plus 2.5, and even with the outsourcing case, slightly positive.
And then another question. What is your view of rentals growth outlook in Norway given softness in housing but very big pipeline in infra construction?
So anyway, we see, and as the estimates are, that there will be good plus growth on the rental market in Norway for next year.
Yes, the Norwegian outlook, there's kind of a softer landing expected, so maybe the high growth that we have seen for a shorter period is expected to a little bit stabilize, but the expectations for the next 2 years are still positive. And this is for mainland Norway.
And the last question, what is your view of rentals pricing in Sweden and Finland?
Yeah, I think this I tried to comment already. So hopefully this answer was answering also to that question.
Thank you.
All right. Okay. Thank you for your attention, and let's continue with some lunch here. Thank you.
Thank you.